Welcome everybody to Lenders Online Commercial Real Estate Series. I'm Dave Stauffacher, the Senior Credit Trainer, here with my colleague, Joe Davis. Joe's a Senior Credit Trainer with us, and it might be worth mentioning Joe's been deeply involved in commercial real estate, credit lending, credit policy, underwriting guidelines, portfolio management. He's done it all. So, by the way, he's also the course creator of this commercial real estate curriculum. So, Joe, how about that for an intro?
Love it. My sordid past.
Yeah, I love it, man. I love these type of things. So welcome everybody to our live stream, our podcast, however we want to define it, but welcome. How we're going to start here today, whether you're a commercial real estate lender, credit analyst, a loan underwriter, some type of loan review professional, we think this course is good for you. We think it covers everything. So we're always glad when people are joining us. We get a lot of questions, and specifically in this series of our commercial real estate, we've been getting a lot of questions, specific in nature, sometimes into global analysis, sometimes into guidelines, sometimes into cap rates, concentration risk, you name it, some types of specifics. So we thought we would actually deviate from that. How about that? We decided we're going to go back to the fundamentals. Now, fundamentals are important to me. A mentor of mine many, many years ago always believed that fundamentals are the foundation. Everything begins with that. Strong fundamentals equates to a strong foundation. And what a better place when we're talking about lending, right? So today's topic, let me think. We're going to talk about real estate collateral, right? That collateral, that's kind of the backup to the backup to the backup. Linda, if you're listening, you probably remember what that is. Backup to the backup. So we're going to start with a question here. So Joe, I'm going to ask you this question. If we actually had two borrowers that came into your office and they had a request for the similar amount of loan, they're willing to secure it with real estate, commercial real estate that is, similar properties, similar types of properties, but one has a higher value than the other. So maybe a simple question, but are we actually taking the same level of risk in each situation?
Not at all, David, and great question. The collateral position is really very different. And that's exactly why commercial lenders spend so much time evaluating property values, spend so much time with those appraisals, spend so much time putting pencil to paper.
Exactly. Great answer. I could have figured that from you. So what we're going to do is actually, we're going to talk about three questions, three main areas. One of them is going to be on the difference to loan to value, LTV. We've often heard that initials, and loan to cost. The other area we're going to focus on is what lenders should actually really care about, and do they care about both, one or the other? What factors actually drive real estate values? So, Joe, where should we actually begin on this one?
Let's start with the basics, David. I like to really start with terminology. It kind of level sets, get everybody on the same page as we're talking. This may be kind of remedial for some folks, but as you mentioned, fundamentals matter, and it never hurts to revisit those kind of groundwork, base layer ideas and concepts. So first, LTV, as you mentioned, loan to value. This is the percentage that is calculated by dividing the loan amount by the collateral value, usually the market value, as determined in the appraisal. Tells you how much equity is in the property. A lower percentage means more equity and a higher collateral cushion, right? Next is loan to cost, as you mentioned, LTC. You'll see that. Same concept, but the denominator here is the cost of the collateral instead of the appraised value. You'll typically use this when the property has either changed hands recently or is up for sale right now. When you start getting 6, 12, 18 months in the past, the cost kind of becomes irrelevant because as we all know, property values shift. But those are the two basics, loan to value, loan to cost. David, why do you think we want to look at both of those? Why wouldn't we look at just one?
I think I look at it from my perspective. I want to understand the whole picture, the full picture of that. Now, you did mention the fact that, we compare loans against appraisal values and cost. Generally, if it's on our portfolio, we think of historical cost, right? Many, many years ago, or even a year ago, that's what it's booked at. But sometimes when you're really talking about cost, it often impacts construction loans. They're constructing something, there's a cost, but now we get an appraisal on what the difference is. So that's why we kind of want to look at both. Many institutions use the lower of cost or appraised value in their collateral valuations. I think it's probably a conservative approach, at least to make the basis of your decision. Now, should the cost and the appraised value be the same? I don't know, but that's the question. If they're not, why? Joe, thoughts?
Yeah, really good point. So in theory, the cost and the appraised value should be pretty close to each other, right? If you believe in the efficient markets theory, those two things should be pretty close to each other. That also assumes, of course, that the appraiser agrees with the cost. But appraisals carry subjectivity, right? We all know there's some gray in addition to the black and white of an appraisal. There's some art along with the science. So the buyers do occasionally overpay. Sometimes they'll underpay for real estate as well. That is absolutely reality. So you often see kind of a divergence between these two numbers, and that divergence is telling you something. And you should absolutely pay attention to it when those two numbers, the cost and the appraised value, are not the same thing. So let's walk through a couple of examples, maybe an example or two, to kind of demonstrate what we're talking about.
Perfect.
So suppose a borrower wants $1 million loan on a commercial property that's listed for $1.5 million. Okay, they negotiate, they go round and round a little bit. Borrower agrees to buy the property for $1.4 million. But here's the interesting point. The property only appraises for $1.25 million. So you've got a delta there. Okay, so LTV, 80%. LTC, loan to cost, approximately 71%. So what should a lender be asking in that instance? Why is the purchase price higher than the appraised value? Is there a redevelopment opportunity? Is there some future upside with this? Or is the borrower simply paying too much? Any of those, or a combination of those, could certainly be the answer as to why the cost and the appraised value differ a little bit.
Excellent questions, great thought patterns, and that's what our job of underwriters and lenders need to kind of understand the full story. Why is there a difference? We understand the issue of subjectivity, but there is a reason, because we have to rely on some basis points of what we're going to lend upon, right? All right, let's do the opposite scenario. We got a borrower coming in. He needs additional capital for whatever reason for his business. He's looking to refinance a property that he purchased 3, 4, 5 years ago, we'll say that. And I bought the property for $700,000. Okay, that's historical cost. Now the appraisal comes in at $1.1 million. So there's $400,000. We use simple math there in value. So now they're different. What should the lender think about? What changed? Thoughts, Joe?
Yeah, absolutely. And you're right. Time can kind of mask some of these issues, but we've said this before, and I would take you back to our prior live stream about appraisals. Don't just accept them at face value. Get in there, roll up your sleeves, read them. Most of them are very high quality. Sometimes you find some issues, but the appraisal is a fountain of information. Absolutely a lot of good info there. Maybe the market has improved since the property was purchased. Maybe occupancy increased. Maybe when they bought it, it was 70% occupied. Now it's 90. That's worth more money. Or maybe the borrower invested in some capital improvements. They took the property from, say, a B grade up to an A grade. Any of those, in addition to just general market appreciation, can impact those.
Perfect. Once again, great questions, great place to explore as we talk about it. Kind of a key credit takeaway for our viewers here is the gap, the change, the delta between the cost and the value tells a story. We often use it, and I talk about this in many of our webinars. We talk about red flags. Maybe there's a red flag here. We just want to know, we want to ask, we want to understand what's the reason. And quite honestly, it's probably one of the reasons regulators set supervisory loan-to-value rates, limits on specific property. Valuations subject of property type can range anywhere from, I believe it's land at 65%, all the way up to residential at 85%. That's a big spectrum there, right? Big spectrum. Now, That's a topic I think we're going to discuss a little bit later. I want to get into the supervisory, so we're going to put that on the back table and do that for another discussion. So let's actually switch kind of into property values. What actually drives that? I mean, we know that loan to value and loan to cost are as good as the value that we're working with, right? We talked about subjectivity. But what actually drives those numbers that we see in appraisal or that we make a determination upon? Joe?
Yeah, great question. You're right. You're only as good as your data. The old acronym GIGO certainly comes into to mind. Garbage in, garbage out. But several factors can really drive real estate values. Location is the obvious one. We all know the first three rules of real estate: location, 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 right? But as I mentioned a little while ago, occupancy levels certainly matter, particularly for those income producing properties. And then demographics and the competitive landscape in the area play a role. Also, think about tenant quality and lease terms. Those will directly affect income stability. So think about if you have a grade A credit tenant with a long-term lease versus sort of a mom and pop operation with maybe a month-to-month or year-long lease. Two very different scenarios, and will and should carry two different values.
I like that. Let's talk a little about, do we have a couple examples or some scenarios that we can kind of portray? I think that actually hones the topic in a little bit. Can you give us one?
Yeah, for sure. I always like to think about retail strip centers. Let's talk about two different ones, because for me, that's a really easy way to visualize these things in my mind. So I've got two different retail strip centers. Each property is 20,000 square feet, so they're exactly the same size. Mm-hmm. Each one generates, let's say, 250,000 in annual net operating income, that NOI. Okay. First glance, those appeared identical, right? Well, when we start doing our analysis and start peeling back the layers a little bit, we see not necessarily the same thing. One center leased to national tenants. Think your Starbucks, your Walgreens. They've got multi-year leases with extension options. They've been in place for a long time. Then the other center is leased to local businesses with 1-year terms. Okay. Even though the income is similar today, the NOI is exactly the same, square footage is the same. Investors will place a higher value on the more predictable income stream and tenant quality. The first one, of course, worth more than the second one.
Excellent. Okay, let's touch a little bit about economics, right? I'm not a fancy or an economics professor, but I do realize that local and national levels are often connected to interest rates, right? And interest rates affect this thing called cap rates, which flow through to the property valuation based on the income approaches. Now, many lenders will hear the word cap rate and kind of like turn off, right? We actually had a seminar, basically had part of our series. We talked about cap rates. Pretty much the basic definition is, okay, it's the expected rate of return on that real estate investment. It's based on, the income that the property generates. So once again, a few weeks ago, I think it was, Joe, you and I talked about that. And I believe if you look and go to our websites on Lenders Online Training, you can actually look for one of our live streams, or actually in our curriculum, talks about financial metrics. That's actually in our commercial real estate curriculum that we've just introduced. Yeah. So let's go back to the cap rate example. Sorry, I diverged. We talked about a property that generates about $200,000 in NOI. So if we had a cap rate and an expected rate of return on that property, we'd have a value of about a little over $3 million. Now, suppose investors wanted a higher cap rate of 8%. At least that's what they perceived on and the risk that they were doing, and they wanted a higher return. Now that value actually drops by $2.5 million. So it's a big enough difference by just changing the cap rate. Same income, same building, yet $900,000 difference in value. How come, Joe?
Yeah, that's an excellent example. Interest rates can drive cap rates. There's other factors, of course, but it's one of the reasons why we pay so much attention to interest rates when we're doing CRE lending. You have to pay attention to those changing market conditions. So when investors demand a higher return, cap rates rise. When cap rates rise, property values fall. There's an inverse relationship. So think about then when cap rates fall, property values rise. Okay, so inverse relationship between those two things, driven by things like economic conditions, but interest rates as well. So with just a few examples that we shared, we begin to understand there's a lot of moving parts with CRE valuation. And that's exactly why lenders need to be really thorough on the front end and periodically thereafter with things like annual reviews and covenant tests.
Absolutely. Definitely. Proper underwriting. We talk about that. A thorough appraisal review. That's in our CRE curriculum. That's great. Are the foundation of analysis. Remember, we talked about fundamentals. We talked about what that leads into the foundation. So follow your guidelines of your organization on the maximum loan to value, maximum loan to cost. Understand that. Do some due diligence on the location. Joe mentioned location. It's a fundamental, but when you start to think about it, it does matter. Tenants, who are they? Are they national? Are they local? Because oftentimes we don't know what the financial standings of those organizations are. When it's a national one, we kind of imply they're strong. If it's a local, we don't know what those mom and pop shops are and how strong they are financially. So, and I think the last thing that I always do is site visits. Go check it out. Go to the property and see what's there.
Yeah.
So, Joe, before we wrap up, I'm going to try something new for our listeners. It's something our followers can take it to the bank, maybe. Actually, that was a pun that I kind of came up with, but we could label our Lenders Online Credit Minute. We could say it's our take it to the bank, but I want to leave you with something. So, Joe, do you have something that they can take to the bank?
Yeah, David, and I absolutely love the pun. I love this new segment in our live streams. And here's today's take it to the bank. Let's say you make a loan secured by a property worth $2 million. Mm-hmm. Does the property really make the monthly payment? No, it's the borrower's cash flow that makes the payment. Collateral becomes important only when repayment stops, only when they default on that payment. So that's why lenders evaluate both the repayment ability as well as the collateral support. Cash flow repays loans. Collateral protects lenders. To your point, it's the backup, right? It's the second or third thing we want to rely on when we're getting repaid. So never confuse those two. A strong property can help reduce loss exposure, but it should never replace sound repayment capacity. The best commercial real estate loans are supported by both strong cash flow and strong collateral.
It's a great reminder, Joe. Any additional thoughts? Those are good.
Yeah, just you never want to get into a situation where you're liquidating collateral. You're in a bad spot if you're in there. You're going to lose money. I think over 30 years in banking, I think I can count on one hand the amount of times that I actually was made whole when I was getting to the collateral phase. So cash flow.
Yeah. Mea culpa. Me too. Me too. Great foundational discussion today. I mentioned about going back to fundamentals. Hopefully that this hit home. I thought everybody would like this type of topic. Loan to value, loan to cost, they're starting points for collateral analysis. You got to keep both numbers in mind. If there's gaps, make it a red flag, as Linda would always suggest to us. Red flags are just an opportunity for us to look a little bit further, figure out why the difference are. Pay attention to the factors as to how the property values move from time to time. Now, next time, we're actually going to be talking to a topic I mentioned a little bit earlier in our broadcast here. We talked a little bit about property type and this 100 to 300 rule, this concentration rule. So we're going to talk about that in one of our webinars coming up. So, Joe?
Yeah, really looking forward to that one. In the meantime, if you have a commercial real estate question or really any sort of lending or accounting question, feel free to send it to experts@lendersonlinetraining.com. And if you found today's discussion helpful, subscribe, follow the series, and please share it with your colleagues.
And remember our take it to the bank. Cash flow repays
loans.
Collateral protects the lender.
That's right.
Everybody, see you till next time. Bye. Everybody.